355,000 in the number of employed in the household survey. That's a huge decline, and it's kind of inexplicable other than to say these numbers are a kind of volatile on a month-over-month basis in the household survey. So it doesn't quite square with what we're seeing on the establishment side, and I know a lot of people are going to be wondering which one is giving us a better picture of the labor market.
Mike, as you look through some of these revisions, what color do we get around the messy report of October? Does this change our understanding of it at all? Something that was punctuated by strikes and weather effects?
Well, everybody's got to dig into this a lot more, Danny, but I think the immediate takeaway is that the narrative that we saw big strike and hurricane-related drop-off in October, maybe not as correct as we anticipated, and it might have been just a outlier month where a lot of people did not get jobs for one reason or another, whereas the November numbers don't show a big snapback, so it does show some extra strength in the labor market this month. It could also relate to the timing of when companies added temporary workers for the holidays, but that is not clear at the moment.
Mike McKee, thank you, sir. Equity futures positive by about 0.1%. Mike, stay close. I want to cross over to Tom Porcelli of PGIM. Tom joins us now for more. Tom, your first reaction to this one, what jumps out to you?
Yeah, so good to be with you all. Look, I think at the end of the day, this report is pretty consistent with what our view has been, which is to say, the labor backdrop has slowed down quite a bit. I think there are some cracks in the labor backdrop, but the floor is not falling out from beneath us here. I mean, we like to look at something called cyclical hiring, and so basically you just take private jobs, you strip out healthcare. We gained 121,000 jobs this month. I mean, even if we exclude the prior month, which was impacted by all the things that we know at this point, Boeing and the hurricane, you're averaging about 100,000 jobs from a cyclical hiring perspective. So again, our view has been that continued economic expansion will roll into the coming year, but you're going to do it with a labor backdrop that has slowed down, and I think will remain soft.
Tom, just to be clear, does this change anything when it comes to December cuts? The rhetoric we've heard from Fed officials.
No, Danny, I think you're quite right to ask this question. No, I don't think it changes anything. I think at the end of the day, I think this is a kind of number that will support the Fed cutting rates in December. I think that, looking for, 2 or 3 more cuts in the coming year, I think is completely reasonable. But again, I think it's interesting, right? Because people were really looking for, sort of or hopeful that this report will really bounce back in a more notable way than what we've seen, and it didn't. And I think that really drives home that when you look at all this other labor market data, all this other labor data have really slowed down quite a bit. I mean, if you're waiting for the payroll report to crack, it's too late. I mean, this is one of the most lagging of economic indicators, and as I think we all appreciate now, is revised relentlessly. So I think when we look at some of the leading metrics, it does seem like things are slowing down.
Does that mean that the bigger risk for volatility in this market, for volatility of policy, is next week, CPI, PPI, import prices?
Yeah, Danny, and that's, again, one of the sort of the unfortunate realities, right? I mean, when you think about the things that really drive monetary policy decisions, a lot of them are lagging indicators, like the payroll report, like CPI. So I think you're right. I think that we're probably going to be swung around by some of this data, because while this report at 227 is pretty reasonable, I mean, you can't discount that next month you're going to have a low 1 handle. I mean, that's how the data have been rolling. And then, of course, you then build in the revisions. It's like you're not just looking at the current month anymore. You have to look at what the prior month did from a revisions perspective. So, yeah, I do. I think that things actually wind up being pretty volatile in that regard.
If you are just joining us, welcome to the programme. You just missed out on the jobs number, 227, a small upside surprise. The median estimate was 220. Unemployment came in at 4.2%. That is the wrong kind of upside surprise. We were looking for 4.1%. Wages coming in just a little bit hotter than expected, in line with the previous month at 0.4%. Joining us now, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, you've had about 7-8 minutes to chew over these numbers. What stands out to you, sir?
Thank you, John. As Jim Bianco pointed out, the challenge for the market and for policy would have been a consistently strong report. This is a somewhat strong report, but not consistently strong. So it is strong on the earnings side. It is strong on the labor participation coming down side, less supply, and it is also strong on a small beat on employment. But the fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points, means that the market will increase the probability of this happening. So on the policy front, this did not complicate what would have been a messy situation for the reasons that Jim pointed out. On the economy side, John, just a confirmation that the labor market remains solid and that U.S. exceptionalism is set to continue.
Mohammed, it makes the decision easy to cut 25, maybe. Still got to wait for CPI next Wednesday. I wonder, though, if it's still just as hard to signal anything for 2025 in the news conference. What is that exercise going to look like in 2 weeks' time?
So it would be hard for this Fed because this Fed is so reactive, is so data dependent, that it will simply tell us that it will remain data dependent. And I suspect that while the range is going to compress a little bit, you're still going to have quite a wide range in terms of the terminal rate. The Fed always has two options. The option it took in 2021 and got completely wrong, which is to look forward. And now it shied away from that and went to the option of being excessively data dependent. And I suspect they'll stay excessively data dependent. So we're not going to get any strong signals other than we will remain data dependent.
Tom, can I get your opinion on this? What it looks like in December, what the summary of economic projections looks like, what they can project forward, if at all?
Yeah, look, I think Mohammed is quite right. I think, prudence, I think, is demanded right now. Powell's he's in a slightly tricky spot. And I think he's laid the groundwork for that, right? Like you think about his speech at the Deal Book the other day. I think what he laid out there to me, I think made a lot of sort of practical sense. They're just going to continue to wait and see how the data unfold from here. They're not going to pre-commit. I mean, he's already laid the groundwork for, sort of a skip after the December meeting. I mean, he's been pretty clear on that, not just at the Deal Book meeting, but during the last presser too. So I think, when I think about the sort of the SEP at large, I mean, look, I don't know that they have to make any wholesale changes here. I mean, the economy is more or less evolving in a similar fashion to what they have there for 2025. So again, I think it would be in their best interest to not really make any wholesale changes. This is a nipping and tucking outcome, I think.
Well, when it comes to the data, and we're still waiting on CPI next week, Mohammed, last time you were on for the jobs report, you said inflation is not dead. What kind of number could we see that could potentially change the Fed's thinking at this upcoming meeting?
And you heard from the chair saying that inflation has been more stubborn than he and the Fed expected. Look, we're going to see inflation stuck in the 2.5% to 3% range for the Fed's preferred measure, the core measure. And the Fed is going to have to make a decision. My gut feeling is that it will run with this number there, promising us 2% down the road. And I suspect we'll see 75 basis points of cuts still, but they're going to be spread out. Like you just heard, it's going to be cut, pause, or skip, and then cut, and then we're going to have a huge conversation. Was this a hawkish skip? Was it a dovish skip? So we're gonna go to the third differential now because we lack proper policy guidance.
Mohammed, you went there. So what kind of skip or cut are you expecting? A dovish cut, a hawkish cut? What are you looking for?
Look, no one is going to predict this when you know that the reaction function of the Fed is backward-looking, because it will depend on the latest number, unfortunately.
And CPI drops next Wednesday. Bond yields right now are lower by about 4 basis points on a 2-year. On a 10-year, we're down by about 2 basis points. Equity futures still higher on a session on the S&P 500 by close to 0.2%. The numbers dropped about 12 minutes ago. I'm going to cross back over to Mike McKee for a little bit more. Mike, you went through what was behind that uptick in unemployment, the snapback that we didn't really get. I think a lot of people in the market were looking for a big snapback in payrolls. Where did we get some growth and where did we miss out?
Well, what's really interesting is we saw a decline in retail sales hiring, minus 28,000 in the month of November when people are usually staffing up, which leads you to believe that there may be some seasonal effects to this. The seasonal adjustment factors may be holding down the number of jobs created a little bit. Trade and transportation jobs also down 23,000, and that's usually when we're seeing the additional UPS and FedEx drivers and that sort of thing. So a little bit of a surprise surprise there. We did see manufacturing rebound with 34,000 jobs, so good news there. Construction only 10,000, and we're looking at the government hiring is one of the highest at 33,000, but almost all that was state and local. Federal government lost 2,000 jobs. And our old friend, leisure and hospitality, did rebound 53,000 jobs total, and about 28,000 of those were in the restaurant business, so people getting jobs there. And then I do want to point out the three-digit unemployment rates, 4.246 for November. So basically just below a 4.3% reading. Would have gotten the Fed's attention, if not worried them. Remember, they forecast in September 4.4% by the end of the year.
Good catch, Mike. As we count you down to the opening bell in about 46 minutes' time, you'll see the outperformance on the small caps. The Russell up by something like 0.8% at the moment. On the screen, up by 0.81 off the back of this move lower at the front end of the yield curve, with yields down something like 4 basis points. Jeff Rosenberg of BlackRock joins us now to get his input on the programme. Jeff, welcome to the programme. The panel so far suggesting the door is still pretty much wide open for a 25 basis point reduction. Is that your sense of thing as well for 2 weeks' time?
Yeah, I think that's the read. This is clearly just reiterating a gradual slowing in the labor markets. As Mike just pointed out, to all three digits, that unemployment rate kind of helps the Fed come in December to cut. The market was already pricing 70% of an outlook for that. And I think the bond market reaction, the initial reaction, is just kind of increasing that on the kind of gradual labor market slowdown. So I think that's very much the read. And as the panel was just discussing, we're going to pivot to this, pause, skip debate and what kind of message that means. But the big debate is over the degree to which cuts have to take place in 2025 and the disconnect between financial conditions, which are going to be easier after today, and the degree of restrictiveness that you still see some of the committee members believe justifies that number of cuts that they're forecasting into 2025.
Jeff, are you arguing then that you need to have a Fed who starts paying attention more to these financial conditions? That conversation has kind of gone by the wayside. Are they going to have to rethink cuts because of what this market is doing?
It's gone by the wayside, but then there was a little bit of acknowledgement of it in Powell kind of acknowledging, yeah, we cut 50 and then the data revised. The whole issue is really about the strength of the economy. And as Mohammed rightly points out, this is a very, very data dependent and reactive Fed. And the data that's key here on how restrictive policy is really economic growth. And you don't see economic growth well below potential. You see economic growth above potential. And that's telling you that monetary policy is not as restrictive as they think it is. Now, there's a little bit of a disconnect between whether you're looking at the growth measures or whether you're looking at the labor market. Take out about 100,000 from today's payroll print. That's hurricane and strike payback. The labor markets are moderating. That's the best evidence of the restrictiveness. But outside of that, you really see the impact on financial conditions, animal spirits. This is a very supportive financial conditions environment. And that's how monetary policy transmits. So maybe you don't need to keep pushing into financial conditions easing by this degree of cuts that they've been signaling.
Well, Mohammed mentioned it earlier about now the third degree. If the door's open for this cut and there's going to be a bias to 25 basis points, then what is the tone and the rhetoric around that? Is it going to be a hawkish cut because they're going into 2025 and there's going to be a lot of change of fiscal policy in Washington?
Well, it's hawkish in this relative to expectations, right? So 2 weeks ago, 4 weeks ago, the market was expecting, a very aggressive pace of Fed cuts. Now we've priced that out from the markets. And so there's a little bit less of a disconnect between the Fed moderating the pace of cuts into 2025 and market expectations. So that may read hawkish, but if it confirms market expectations, not so problematic. If there's a even greater acknowledgement of that, I think that would be surprising. And that would read hawkish. I think when you get into 2025, it is going to be about understanding this pace of cuts has to slow because the economy and the data doesn't support the amount of restrictiveness that the Fed thinks they currently have.
Another round of Fed speak coming up today, and then obviously we're going into the quiet period. I think they've been quite consistent through the week so far. We've mentioned this quote from Governor Waller in a speech from him earlier this week, cut or skip. This is what he had to say on the neutral rate. There is still some distance to go in reducing the policy rate to neutral. Tom Porcelli over at PGIM, I just want to give you a final word just quickly on the neutral rate. They think they're a long way away from neutral. They think they've got space here, which means they can carry on cutting interest rates. How much distance do you think there is between where we are and where neutral might be?
It depends which Fed official you ask, right? I mean, think about the dispersion in the estimates of what neutral is. I mean, the low end is 2.25, and the upper end is 3.75, right, per the long-term dot, obviously nominal we're talking here. That's 150 basis points of spread. So depending who you ask, you could be really far away from it. I think what's going to wind up happening, John, is this. So if you look at the Fed's 25 dot, the median is 3.4%. I think what's going to wind up happening is that's going to shift higher, right? And I think to Jeff's right point, I think it'll wind up shifting higher to where the Fed, where the market is, right? The market is pricing in, I think, 370 right now by the end of the year. So you take out one of those 4 cuts that they have priced in for next year. I think it falls in line with what the market is thinking, and I don't think that has to be terribly disruptive.
Tom Porcelli of PGIM. Tom, appreciate your time, sir. Thank you. Mohammed, I want to come back to you on the same question. I think this is an important debate. How we reconcile our differences here between where the market might believe neutral is and what this Federal Reserve is signaling. How do you think we close that gap?
I think we close it by fudging a very key variable to all this is what is the inflation target. John, if your inflation target is 2%, then you should not cut in December. If your inflation target is somewhere between 2.5 and 3, which is justified by all the changes, all the structural long-term changes going on in the economy, then you cut. And we are fudging this. No one wants to talk about this. I don't know if you saw a few Fridays ago in the afternoon, the Fed put out its discussion of the monetary framework coming up and said explicitly, we will not discuss the inflation target. But critical to all this is what de facto inflation target will they run with. My own gut feeling, as I said, John, they're going to run with slightly higher, and that means that ultimately they'll end up somewhere between 3.75 and 4.
Mohammed, what about the argument that they can't abandon what they have now as their inflation target because it's important in setting expectations? It's important not to have people run away and think that we're going to have higher sustained inflation and therefore change consumer habits. Is there any credence to that argument?
I think there is, and I think there's many ways to do it, and people have come up with different ways. My concern is if they truly believe that 2% is somehow given to them, it's not an arbitrary number, and if they try to get there and stick to that inflation target, they will sacrifice the American exceptionalism. That's what I'm worried about. But Danny, at the end of the day, I think they're going to fudge it by saying 2% down the road, and it's just going to be a very long road.
Jeff, do you agree with Mohammed that 2% down the road is going to be very long?
I do, and I think this is a really important debate, and the Fed has had this debate, and I agree with Mohammed. They're not going to announce a change to the inflation target. They're going to stick to the target. Danny, for the reasons you point out, they agree as well. It's very important to expectations, but there's a lot of room for interpretation, and so 2, 2.5, 2.6, 2.7, and I agree with Mohammed that the cut in December of 25 basis points is kind of telling you where they lean on inflation versus growth. I think there's some long-term consequences for that, because if the bond market wakes up to the fact that there's a tolerance for inflation, and the real test is, as long as inflation is gradually moving lower, and even if it's moving sideways, they can kind of play this fudge it game. The real test is what happens if the acceleration in growth, the impact on financial conditions starts to press on inflation. And the one thing we didn't talk a lot about, and it's hard to see here whether the wage number today and the slight uptick is just a mix shift or not, but you haven't really seen the wage numbers kind of conforming to, depends on productivity, the 2% inflation target. The real challenge is going to be, what do they do if inflation starts to go back up? Not predicting that, but that's where you kind of are going to put this 2 versus versus fudging to 2.5 really to task.
That's the risk for 2025. Jeff Rosenberg of BlackRock. Jeff, thank you, sir. If you are just joining us once again, welcome. 227 is the number. It's an upside surprise against a 220 estimate. Unemployment just creeping a little bit higher. 4.2 and very close to 4.3. The estimate was 4.1%. The takeaway for a lot of people in this market, it leaves the door wide open for an interest rate reduction on December 18th. Still one more data point still to go. CPI next Wednesday. Mohamed Al-Arian still with us for some final thoughts. Mohamed, we all noticed that you published the FT column ahead of this conversation this time, and I noticed the content of that piece as well. It's not about whether the US will outperform. It will. It's the extent to which it will diverge from the rest of the world. You noted earlier this week, and I think it's a perfect time just to finish and think about the rest of the global economy. As we get 227 in America and start to complain about whether that's good enough, the rest of the world is struggling. You noted China and a potential Japanification of China's economy. We've noted Europe's inability to govern itself throughout the whole week so far. In a tripolar world, Mohamed, what does 2025 look like?
It's a world of dispersion. John, I've been saying with you for the last few months, the good, the bad, and the ugly of the global economy are to follow. The good is the US, the bad is China, the ugly is Europe. And we've had confirmation of that over the last few weeks. It is a world where there's going to be significant differences in the three systemically important economies. And that's going to play out in the currency market, first and foremost. It also is going to play out in yields, but it will continue to suck capital into the US. And that's the good news for US markets, that if you think of TINA, there is no alternative. There is right now no alternative to American exceptionalism in relative terms.
Mohamed, just to hang on the point of Europe, Robin Brooks of Brookings wrote a column yesterday basically saying Europe desperately needs a weaker euro, and now should be the moment where the ECB decouples from the Fed, where they cut, and they cut aggressively because they need some sort of stimulus that's not coming through governments in Europe. Would you agree with that?
A weaker euro would be like pushing on a string. What Europe needs is fundamental structural reforms. The Draghi report sets out the fundamental problem they have with productivity, with competitiveness. A weaker euro stimulus doesn't address those structural issues. So, Danny, I think it's much deeper than that. And I think that Europe has to understand that unless it takes serious steps, it will fall further behind. Unfortunately, the minute you say further step, you need political leadership, and we know what the situation is like in France. We know what it's like in Germany, and there is no European policy without France and Germany leading right now.
There is very little leadership, that's for sure. Mohamed, we're lucky to get some time with you. Appreciate it. Mohamed Al-Arian there of Queen's College, Cambridge, on this Payrolls Friday. Looking ahead to next week already. The ECB's just around the corner, December 12th. Let's get to the week ahead. It looks like this. Before we get to the weekend, we're going into the quiet period for the Federal Reserve, so look out for some comments from Bowman, Goolsby and Hammack as well. And then as we get further into next week, on Tuesday, OPEC holding its year-end conference. Wednesday, we get some CPI data. Thursday, PPI and another round of jobless claims. And then that ECB interest rate decision. The guest lineup on Monday looks like this. Neela Richardson of ADP, Chris Harvey of Wells Fargo, Peter Oppenheimer of Goldman, and the IIF president, Tim Adams from New York City this morning. Good morning to you all. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
In case you missed it on Bloomberg Open Interest.
We'd love to hear from you. We'd love to hear what you think about our shows here on Bloomberg Television. Do you think we're doing well? Do you think we need to change some things?
Do you like Matt Miller?
Should I wear a wig on a regular basis?
Please write that in. I'm scared.
The first monthly loss for the S&P in 7 months, 30 minutes until it started trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Don't miss Open Interest live weekdays.
Yeah, I think that it would be irresponsible for us to ignore the AI revolution. I think that as much as there is a lot of short-term hype, I think long-term it has the potential to be transformative. And so we are spending a lot of time thinking about what elements of it are structurally have barriers to entry. And so there is a winner-take-all element to that and which don't. And it seems to me that things like chips, things like infrastructure and systems has a little bit of that, because NVIDIA is so far ahead, it's expensive to catch up. There's, the technology that it requires to build these chips are sort of based in Taiwan. What we're seeing is that some of the apps and some of the applications, there are no barriers to entry, right? Like, it's fairly easy to come up with, and I don't mean to belittle the complexity of it, but there are not moats around those things like they used to. So I think that there is less of a winner take all in that space. You're gonna have to earn that spot, whereas it'll be fun to watch what happens. And I think there's gonna be a lot of money burned in the process, because somebody will develop something and a fast follower will come along and make it better and cheaper, because data gets cheaper and more pervasive, and it's gonna be easy for new players to come in and do interesting things. So I think we wait and we see.
You can have a baby anywhere you want. It's the environment and that care. That is what matters most.
Our investigation found some of the worst cases of harm were surfacing.
मुझे क्या पता कि भला के चक्कर में मेरा ही बुरा हो जाएगा।
I never thought I would be vulnerable to a scam. This ruined me, and I didn't have any real good explanation for it.
Wildlife trafficking is almost always driven by greed.
Once you start focusing on money, you lose sight of what is best. That's where things go wrong.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Futures turn higher after the jobs number beats. 30 minutes until the start of trading. I'm Matt Miller.
I'm Shonali Bassett.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the labor market bounces back from storms and strikes. The U.S. added 227,000 jobs in November, and that beat estimates.
And the view from the White House, BlackRock and PIMCO. We'll get reaction from all of them on the jobs report, as well as acting labor secretary Julie Su, CIO Rick Reeder at PIMCO is going to join us, and at BlackRock's going to join us, and PIMCO economist Tiffany Wilding.
And Trump taps venture capitalist David Sachs as his AI and crypto czar. The pick underscoring, of course, the president-elect's intent to boost two rapidly developing industries. All of that and more coming up. But let's take a look at where markets are trading. As Matt said, 30 minutes until those bells ring. A little bit of green on the screen, a little bit of a lift after those numbers. It seems like the view prevailing right now is that we didn't get anything that is going to change the Fed's course this month when it comes to rate cuts. As such, a little bit of a muted but positive reaction. The S&P 500, the NASDAQ 100, higher a little bit to the tune of 0.1%. Then you take a look at the bond market, a little bit of a rally as it comes to the 10-year Treasury yield, down about 3 basis points. But watch these levels, Matt Miller. We are well below 420 right now, getting closer to 4%.
All right, interesting move in yields for sure. We're looking also at Tesla stocks within striking distance of a record high after losing, remember, 75% of its value in 2021, 2022. But Elon Musk, the world's richest man, has now given more than $270 million. It's won him great influence over the incoming White House. And now his buddy, part of the PayPal mafia, David Sachs, is going to be an advisor as well to Donald Trump.
That's a lot of money. David Sachs had given a lot of money as well. We'll talk about that a little bit more later in the show. Right now, we're going to talk about some stocks moving pre-market. Just Lululemon surging more than 8%, almost 9% pre-market. There was strength in their international business. They lifted their guidance for the year. Ulta Beauty, another consumer stock, up more than 10% pre-market. Petco also rising higher after positive results. But higher, 23%. You know, I have a dog myself, so you got to love to see it, Matt.
Yeah, I mean, you'd pay anything probably